There are quite a few discussions around insurance these days. One that's been talked about, but maybe not enough, and is getting more and more focused now, is how credit scores can have an impact on how much you pay for homeowners insurance. Pleasure to be joined by Ben Keys, professor of real estate here at the Wharton School. Ben, great to catch up again. How are you, sir?
I'm doing well. Thanks so much for having me, Dan.
Yes, absolutely. All right. So the bigger question I think I have right at the top is, do people realize the level of impact that a credit score can play on your homeowner's insurance rates?
Yeah, I don't think they do. I was certainly surprised by our findings in this study, looking at households with a very rich data set to see just how much their credit score impacts the cost of homeowners insurance. And it turns out it's quite a
Hmm.
lot. We've had many discussions over the last few years about climate risk and some of the rising costs there in terms of where you live, but they're not just pricing on place, they're also pricing on people.
Right. And so there's a couple of components to discuss here. Speaking about the people, uh, is there a significant difference when you're talking about credit score with lower and higher income families?
Yeah, I mean, so certainly there's a strong relationship that people with higher incomes have higher credit scores, but it's certainly not a one-to-one relationship. One of the things that we're struck by in this analysis is thinking about what credit scores are proxying for when insurers use this in their pricing, and so they're not allowed to use credit scores in all states, and we'll talk more about some of the variation across the country in this. But when you're looking at this, one of the challenges is, well, credit score is correlated with a lot of other things and a lot of other attributes. And so, from a research standpoint, we wanted to try to find a setting where we could isolate just a change in the ability of insurers to use credit scores, rather than all of the other things that credit score might be correlated with.
Now, the other component, which you and I have talked about, is climate risk. And your research talks about the fact that credit score, in many cases, is an even bigger burden at times than the climate risk component.
Yeah, we were very struck by this. That if you look across much of the country, so not in the most risky parts of the country, but if you look at the rest of the country, the vast majority of the distribution of households in the U.S., your credit score is actually a bigger determinant than your climate risk. If you were to just improve your credit score a little bit, that's going to have a bigger impact on your cost of insurance relative to just doing a small reduction in your climate exposure. And so if you could think about the kind of the gradient between your expected losses or the gradient between your credit score, it's that credit score relationship that's actually steeper. And that might undermine sort of some of the incentives to reduce your risk or to mitigate some of the hazards when you might be better off paying down some of your credit card debt
Right.
and improving your credit score. That might be a quicker way to lower your insurance bills.
Do we know how much we're talking about here, differential, whether it be percentage or actually dollars wise, of the type of difference we're seeing with people that are paying more on their homeowners insurance to people that are paying less?
Yeah, so in our study, we find that all else equal, households in the top quartile of credit scores pay about $550 a year less for insurance than those in the bottom 20%. And that's the average. That varies quite a bit across the country, and it's quite a bit larger difference in the highest risk areas. So there's kind of a double whammy for living in risky areas that if you have a riskier location and also a lower credit score, you're going to pay substantially more for homeowners insurance.
Now, I'm sure there are going to be people out there that are going to say that laying this out the way you have, it's a bit of an unfair process for those at the lower end of the spectrum. What do you say to them about how to kind of deal with this and mitigate it the best way that they can?
Well, this is the tension in setting risk-based pricing. And, three states have banned the use of credit scores in setting homeowners insurance rates: California, Maryland, and Massachusetts. And the view in those states is that it isn't a fair practice to use credit information to set your homeowners insurance. In the other 47 states in the country, you are allowed to use credit scores, although to varying extents. And I think what that suggests is that there's a variety of opinions on whether this is fair from a sort of policy standpoint. I think
Right.
actuarially, the insurance industry says, well, there's predictive power in the credit score, it's proxying for a bunch of things. And if we try to unpack what some of those things are that it's proxying for, one might be that that people with lower credit scores live in riskier areas.
Right.
That's something that we can account for very well in our rich data from McDash and CoreLogic. Some of it might be that they live in older homes, and so there may be a difference there in terms of the potential risks. That's another thing that we can account for. But I think there's a couple of kind of remaining concerns that are out there. One is related to household liquidity, just the likelihood of filing a claim after an event rather than using your savings to cover it, and sort of recognizing that multiple filings has a negative impact on the cost of insurance going forward. So that dynamic story, or it might be kind of a proxy for conscientiousness, that the people who, miss a credit card payment are the same people who might not be maintaining their homes at the same quality level. And, the insurance industry doesn't necessarily unpack those different drivers. They don't have the data to do so. And so they use this catch-all of a credit score as a proxy for these things. And you can see in their models, they argue that it's a strong predictor of ultimately the losses on a given property. So that's the trade-off. Is, this idea of fairness is, from actuarial standpoint, is this seen as fair, versus politically or socially, do we think that this is fair? And when you see examples of next door neighbors paying 2x what the other one is paying, you start to think, well, that doesn't feel like a very fair system.
What do you think then are some of the solutions? And is there a potential federal solution? Because obviously most of this work is being done at the state level, for the federal government to try and help address some of these challenges in the insurance market.
Yeah, the tension is that the states really, are the ones who regulate homeowners insurance, and the federal government only plays a very small role, if at all, at the moment. And so this is a state by state process to determine, what is the ability of the insurers to use additional information, and what is this actually proxying for? What is it capturing? I think we need better data from the industry to connect this to claims data, and to understand what some of the underlying drivers are of the pricing relationship that they see, that they're then passing on to the homeowners in the form of higher premiums.
What about the federal reinsurance market?
So the federal market doesn't, there isn't really a federal reinsurance market when it comes to homeowners insurance.
Right.
There's a federal flood program, and they don't price credit scores in this same way. So you don't see the same relationship in the National Flood Insurance Program. But I think, in terms of addressing sort of credit score related issues, it really does become a state by state story. And in our paper, we dig into a policy change that happened in Washington State, where they essentially flipped the switch and said you can't use credit scores, and then flipped the switch back after intense lobbying from the industry. And there we could kind of hold a lot of the other characteristics constant. These were the same homeowners in the same houses with
Yeah.
the same insurance carriers in most cases. And we can see exactly what the effects of, taking credit scores out of the pricing model did to the cost of insurance.
But the challenge for the consumer continues to be one where there's not a lot, it seems like, that they can do on their end to be able to have a significant impact to make this system work better down the road, it feels like.
These are challenging times in the homeowners insurance market. We are seeing some softening in a few of the most expensive spots in the country, but in general, insurance prices are up quite a bit. The McDash data suggests that they're up almost 7% over the last year, which is far faster than inflation. And that's after multiple years of double digit growth. And ultimately, what our study is pointing to is that this insurance burden falls most heavily on the lowest credit score households. And so
Yeah.
those are the households that have the least cash on hand and that need insurance the most. They're the ones who are going to benefit the most from having this protection in place in the event of a disaster, and they're the ones who can afford it the least. And so that's really the tension in this market right now.
Ben, great to talk to you again as always. Thanks very much.
Yeah, thanks so much for having me, Dan.
Thank you. Ben Keys, professor of real estate here at the Wharton School.